Okay, I'll start the webinar. Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Today on March 3rd, between 8 and 8:45 GMT during the start of the European session, I gave Tracking the Forex Market Together Part 1 because once a month I give the twin webinar. During that time, I take the positions during the Part 1 of the webinar and subsequently explain to you what happened to those positions and how exactly they are handled, and the importance of the trading strategy will explained. Now, the part 1 of the webinar is being recorded by FX Street, which is available in the webinar page of FX Street. So there, those who are not attended part 1 probably can just go through that part 1 by visiting the webinar session of FX Street. Now we are into part 2. And in this part 2, I'm going to explain briefly about the simple market tracking technique and also the ways by which we'll be able to identify the type of moves they are doing it in the market. And also I'll explain the trading strategy, how important it is during this particular part of the month. This is being the first week of the month. The market is expected to make volatile moves. And then I gave you the forecast, what is being derived using my statistical algorithm, which I gave it yesterday during the Asian Session Live Market Analysis webinar. And if you look into that, the market is expected to make a swing and rise move during that of the European session. And 8 GMT up to 8:45 GMT, I was giving the webinar. Now we are in 14 GMT. The European session is over. And then it is a gap time between the European and the US session. And the US session starts by 14:30 GMT. And if you find out, the swing and rise move in the case of Euro and GBP were expected. And also I was explaining that the market reading technique using the initial lows and the highs which are set around 3:30 GMT. And I noted down them and also compared it with that of the live market code page. And if you look into it now, Euro formed the low 1.1177, and during that of the part 1 of the webinar, I was telling you that up to 8:30 GMT, they did not breach the low. So they are unlikely to breach the low during rest of the session. But what happened? They breached in the case of Euro, the low, and came down to 1.1155, and that shows that they found the stops below that. And that is the problem with regard to the trend reversal time. During that of the trend reversal time, whatever the technique they follow, if you identify and try to follow the same, still they will try to make some moves against our expectations. Hence, I was telling you that the hedging is very important. I'll show you the results of the trades, what I had taken during that of the early part of the European session. So they came down below that. Still what is happening? They are holding below that of the initial low. 1.1177 is the initial low. Still they are holding below that. And in the case of GBP, 1.5356 was the low. And they made an upward stop and then subsequently made the slide. And they were expected to gain the levels as per the algorithm during that of the European session. But instead, they made the downward move and came down to 53.45. And a nominal downward move from that of the high low, about 11 pips. And then subsequently, they are holding below that of the initial low now. But it is a gap time now. So gap time moves are false moves. So they are holding below that. And during the session, they are expected to make the firm up move. Whatever the gap time move they show, just opposite to that happens during that of the early part of the next following session. Then in the case of USD yen, I was explaining that they just breached the low 119.59 by 2 pips and then started gaining the levels. I took the sell around 119.78, which is showing a nominal profit, and they are making a dip now. So they are making a contrarian move in order to make a dip in the case of the yen crosses. So Euro, GBP as well as yen, they are making a drop as a contrarian move. So during that of the trend reversal time, the month beginning and the month end time, they are expected to make very frequent contrarian moves because they have to handle the derivative market of the crosses also. That is why they make such quick moves. Then in the case of CHF, they have breached the high and not breached the low. I was telling you that they are expected to make further rise, but still holding above that of the initial high. Then in the case of Canadian dollar, they came down from that of 1.2515 and came down to 1.2491 and went up. So I took a sell around 1.2506. It went up to 1.2524 and holding it. My hedging order was at 1.2536 and that was not filled. And after the 1330 data, they made a very quick drop. Then I booked a profit in the case of USD CAD. Then Australian dollar, the low they are not breached it. High they breached it initially during that of the Japanese session and then subsequently holding around 78. And they are still holding around that of the entry level 78.20 during that of the gap time. During early part of the European session, they are expected to make a firm up and rise. Probably at that time, we should be able to book profit. Now the forecast says they are expected to make a swing and slide. So it might be a sideways move during the US session. So what we can do is hold the positions what we have taken now and try to book profit in those sessions, in those positions. So first of all, we have to note down the derived forecast. I told you they are expected to make a swing and slide move during the US session. And then we have to do the market reading. In that market reading, I explained to you that they are holding Euro and GBP below that of the initial low still, but it is a gap time. The gap time moves are false move. And during that of the early part of the US session, we'll be able to see that they will go firm up a little bit and then probably make further slide. And they may not make a very big drop, but they will make only a gain and a slide, and market will be hovering around the same level. Because there are a lot of prime data to be released from tomorrow, day after, and on Friday. So the traders are not participating in a big way. That is why you find the market has become very sluggish. So you have to understand that many of the institutions, they don't do the trades on a daily basis. They look for the prime data release time and make quick decisions with regard to trading and then take positions. So when in the absence of such big volume of trades, the players have to wait for the traders to come in. Only then they can make big moves in the market. So I'll show you the trades what I have taken. So in the case of Euro, the low was 1.1177 and they did not cut the low for 30 minutes from the start of the session. And during that of the trending time, if they don't cut it, normally they make a rise. Okay? Quickly they will make a rise, and probably any data release which happens around 8:30 or 9:30 GMT, they quickly make use of it and make the upward move after making a brief downward dip during start of the session, in the case if they don't breach the initial low by 8:30 GMT. But today what's happened? They just made the swings near that level, and subsequently around 10:30 GMT, they started breaching the initial low in the case of Euro to start with, and then subsequently in the case of GBP also. So I kept that stop at 1.1158, sorry, the sell stop, that is the hedge order, and that got filled because they came down to 1.1155. And then subsequently they did not cut it for 10 minutes. So immediately I closed it with stop at entry and then kept another hedge order 1.1128 and started moving it upward now to 1.1158. So the original sell stop level. So this way, we will be in a position to handle the position and also not taking much of a risk. We only take a chance for 30 pips. And in the event, if the going is no good, we hedge it and watch for 10 to 30 minutes. If the hedging is not making profit in 10 minutes, we understand that was only a brief downward stop before making a rise. So we just close the hedge, we stop at entry, and then subsequently keep another hedge order. And once they start gaining the levels and go above this of the sell stop level, about 20-25 pips, we move the sell stop to that of the original level so that we are not incurred any loss here. At the same time, we hold our buy position also. In the event if you use a stop, what happens? The stop gets filled and we lose our position. Then we think that the market is bearish, we try to take a sell, afterwards they start gaining the level. So they invariably, if you use the stop, what happens? Our sentiment or market perception is being influenced by the trade. And then we look for the chart and we also try to accept the chart which is showing the moves in line of our expectations. Most of the time, you come across the people using the technical analysis, they're going for the 5 minutes chart or 10 minutes chart, then 30 minutes and 4 hours chart, and try to develop a bias. Okay, the market is bearish. Then any kind of information, they will think, oh yeah, this is what bearishness, this is what bearishness. The bullishness, they will try to discount it. So this is normal human tendency. And in that process, if you want to come out of it, then probably we should not become bullish or bearish and try to keep a hedge order to limit the risk, because the basic idea of understanding the market using various type of analysis is to see that we are not hedged, see that we are able to book profit in our trade. And in the process, if you try to see that our position is hedged and the hedge is making the loss for 10 to 30 minutes, we can close the hedge and keep another hedge order. And then once they start gaining the level, we can try to move the hedge order to the original level. And then subsequently, we can move the hedge order until we are able to keep stop at entry in the original entry position. So this is how we should be in a position to handle that, so that calmly we'll be able to handle the position and every trade will try to capture profit. Then in the case of GBP, then I kept the hedge order or the sell stop at 1.5338, 30 pips below. Still it is not being filled. At the same time, the original buy position is making a nominal loss. Then in the case of yen, 119.78, I took a sell position. Currently, the market is around 119.71. We can close the position with small profit. So that gives about 7 pips profit. Then in the case of USD CAD, I took a sell around 25.06 and came down, and it came down to 24.35, and it came initially to 24.41, and then they made a small dip from there to 24.39 and then to 35, which indicated the quick larger drop followed by a small drop. 3 times they do it. That means because it is close of the European session time. 13:30 GMT, 14 GMT, there is a close of the European session. So they simply reversed that market. So before that, I closed it with 64 pips profit. Now, with regard to Australian dollar, which is also around that of the entry level. So we cannot do anything unless and otherwise they make further small rise, like yen, we will be able to book profit, a small profit, because they are expected to make a small swing and then slow slide in the case of euro and GBP and also Australian dollar during this session. So it is not advisable to hold the long position for a prolonged period. But you can do it provided you have the hedging to limit the risk. And then subsequently, tomorrow they are expected to make a dip during start of the Japanese session and then start rising it. If you are holding the position till such time, then probably you will be able to book profit on the buy side. If you have missed the opportunity of booking profit or the profit booking opportunity was not available, then subsequently you can wait for the market to show it during that of the next session and then try to book profit during that time. So that is why I'm giving the entire week forecast on the Mondays so that you'll be able to make use of it. So ultimately, whatever be the forecast, whatever be the market reading, the market can go against us. We have to keep it in mind. And we think that we are smart and able to read the intentions of the players. And the players have got so much of control over the market. They have got so much of influence with it of the other institutions on the back. So obviously they will be in a position to handle the market differently. So in such a situation, we'll come across that the players are here to hit the stops and try to earn out of that. So this is what we come across in the market. So what is more important here to understand is that even though we have done the studies properly, and during that of the trend reversal time, the risk is higher. And during that of the month beginning and the month end time, because they have to handle the options and the futures, the derivative market positions, which are extreme positions. So only when they make big upward and the big downward move, they will be able to hit them. And then during that of the other weeks of the month, they will be making the trend reverse. They will be making the trending move. Then at that time, you will find trading becomes relatively simple. Hence, I suggest to that of the small traders, those who have got lesser equity, to focus on trading during second and third weeks of every month and avoid taking positions during that of the first and the last week of the month. Hope you are able to understand this. Now, these are all the session timings. 14 to 14:30 GMT is the gap time. Then afterwards, the US session starts by 14:30. We'll be having the webinar up to 14:45 GMT. So we'll try to find out what sort of moves they are making in the market. So during the gap time, they will be making the false move. And from that of the third week of March, we'll come across the daylight saving system is going to start in US. And so the US timings will be changed accordingly as the onset of the summer. So I explained the type of moves there which we need to recognize, namely the stop point and the false move, which happen in less than 30 minutes during the start of the session and also during that of the gap time. Then they make the extended move, which is also another quick move, which happens up to 2 hours. They just go below that of the initial low and stay there for 2 hours and then start reversing it. Or go above that of the initial high and stay there for 2 hours, not for 30 minutes. If they stay for 30 minutes, it is stop point. If they stay for 2 hours, it is extended move. If it is a quick move, then they will reverse on the downside. And probably before that of the data release, they make such moves. And also the false move before that of the data release. And Then the intentional move happens after the data release, and that could be for 2 sessions and the start of the third session, but it will be a very slow pip by pip move. So that way we'll be able to differentiate. Whenever the volume is less, they will try to make the move closer to that of the high or closer to that of the low, the small swings. So the small swings for about 15 to 23 pips near that of the high or near that of the low. Sometimes what they do is they just make a swing from the high to the low, low to the high, high to the low, and that way they do it without breaching the high or the low. That is also considered as swing. Now, once you identify the type of moves, then we have to understand how they alternate the moves. So, as I explained to you, the session timings. What they do is during the early and the late sessions, they handle the majors. During that of the mid sessions, they handle the crosses. So this is the way in which every session they make the moves. Then subsequently, you find when they start making the moves during that of the early session, then that might be an intentional move or an extended move. Then they will slowly come to that of the crosses and make small swings in the majors and handle the crosses aggressively. Then during the late session, they continue to make quick moves in that of the majors. So this we have to understand first of all. So also we need to choose the currency which is making more than 40 pips spread between the high and the low in order to take a position. If you take a position in a currency wherein the spread has become more than 40 pips, then you could be able to see a quick move happening. Otherwise, it will be very sluggish. We may have to close it with a small profit. Now, coming to that of the trading strategy. So, when the market is near that of the high, do not breach the high for 30 minutes from the start of the session. We try to take a sell. But if the market is making a false move during that of the gap time, now here 14 to 14:30 GMT is the gap time. So 14 to 14:30 GMT is the gap time before the start of the US session. So what happens when they are making a small firm up or a small slide? Then we have to take the contrarian positions. So in the case of Canadian dollar, they just formed up. And after not breaching that of the intermediary high, we can try to take a sell position during start of the session, then they will make the slide. And in the case of euro, they are in the middle level, GBP also is slightly closer to that of the low, and here in the case of yen also in the middle level. And in the case of CHF, it is closer to that of the initial high, 0.9595 level. So we can take a buy if they make a small dip during the gap time, so that it will make us gaining move, and we can keep 30 pips hedge order, and once the position makes profit, we can book profit here. Otherwise, in the case of Australian dollar also, it is in the middle level. So it is not advisable to do the gap time trade at the moment. And once the session starts, we can watch for 30 minutes from the start of the session and then try to commit positions. Anyhow, since I have taken the positions during that of the European session, and I am carry forward the positions to that of the US session as well. Euro, GBP, and yen I have closed this, Canadian dollar I closed it, and Australian dollar. These three positions I am carrying out to that of the US session, and I'll also explain and answer to the questions we are asked, and then subsequently we'll see how far the progress is happening in those trades. Meanwhile, we will watch the market also. So I'll try to answer to the questions which are asked here. The Then calls has got a question. It can you explain the details, swing, slide, firm up, rise, etc. Now, market can make either an upward move or a downward move. A small upward move of about 25 pips or 30 pips is firm up. And a bigger upward move around 45 to 70 pips, 75 pips is a rise. And more than 75 pips is quick rise. So these are all the qualitative attribute for the pip moves, because we don't have any yardstick for any of the data release time. During the non-firm payroll, how much of pip they will rise? Because some people take the average during that of the non-farm payroll. Last time they made 80 pips, and the previous month they made about 120 pips. And similarly, they take for all the non-farm payroll release and try to find an average of that and say that, okay, around that average, they will try to make a move. But it doesn't guarantee whether they will make only a move less than that or more than that. And that sort of variability is bound to happen in the market. And here, my algorithm says that what could be the quantum of move? And instead of giving it as about 110 pips rise, etc., I am giving a qualitative attribute to that instead of a quantitative number. And these are all the firm up, rise, and quick rise. Then on the opposite, this downward move, the slide about 15 to 25 pips, and a drop. I don't find any drop in this. So drop for about 45 pips. And then a quick drop for about 75 to 100 pips. So that will be the opposite of that of the rise. So firm up is a small move similar to that of slide, opposite to that of slide. Then rise is opposite. So then the dip of 45 pips, then the drop 75 pips. So quick rise opposite to that is drop. So that is how they are all the qualitative explanations for that. For the quantum of move, they could do it in the market. So that that will help you to approximately estimate how much of profit you'll be able to envisage during such moves. Then Jen has got a question. In case for cable, what level low do you expect it to go before it resumes the upward direction? See, as far as the levels are concerned, I already given it on Monday webinar that they could come down to 53.50. That is what the mathematical estimate shows. And if you just go through that of the Asian Session Live Market Analysis webinar, I have given it on 2nd, which is also recorded and displayed in FX Trade. Under the archives of webinars, there you will be able to find the expected range for the week. And that you can make use of it to find what could be the possible lows. So in order to reduce the uncertainties, only I am trying to give all these informations. What could be the possible move and also the levels. And beyond that, I don't know what I can give. So do you see it is going to 1.5290, 1.5260 later this week, or do you think that 1.5320 will provide the support needed to push the pair higher? See, what an amount of uncertainty. When you ask so many questions of this nature by looking to the various levels which are derived using various types of statistics, which will only add more confusion to your analysis, and also it will change your mindset and the market perception. So what will happen when they come to that of 1.5345, then immediately you think that probably 1.5320 it should reverse. Then once it goes below that, even 2-3 pips, then you think that 5290 could be the support and 5260 could be the support. And you know that when a lot of stops below those levels, the players can go below and hit all the stops. If the traders have already shorted around 1.54 and things like that, waiting for further drop to book profit, then the players may not drop and they will simply make a small dip and then reverse the market and induce the short sellers to go in for a short covering. So it is the question of that all the traders' positions against the players. So when you try to derive these levels using various types of statistical analysis, don't you think that it adds to your uncertainty? And once you have the uncertainty in your mind, you are not in a position to enter into the market. Besides, already loss-making positions or already you have made some losses and stops are hit, then you become doubly cautious before entering into the market. So in such a scenario, do you think that the forecast is important or the trading strategy is important? Okay, fine. I had taken a buy position around 1.5365. Then 30 pips below, I am keeping a hedge order. And in case they come down, I am able to physically watch what is the low they are setting it for 30 minutes. And once they set the low and go above that of the initial low 1.5356 in about 2 hours, I understand that they made a brief downward extended move and then started going above that of the initial low. When they stay above that of the initial low for more than 30 minutes, that means they will resume the upward journey. So I'm able to take a decision on that. And also the trading strategy helps me to limit the risk and also understand when the hedging has to be closed. In 10 minutes of my observation, in case if it is hedged and the hedging is not making profit and also the position, the market is not going below that, then I simply close it with 2-3 pips loss or at stop at entry. And then the market moves up, I'm able to keep another hedge order and move the hedge order to that of the original hedged level. So try to understand. Imagining the levels only add further uncertainties. That is the whole problem with regard to the statistical analysis. When you apply various types of statistics, we come across various types of the levels. So on pivot point, you might come across one level. On Fibonacci retracement, you will come across another level. And also levels of Fibonacci retracement and also MACD crossing over. So when you look into that of various type of analysis, various levels could be considered as the support. And you know that when all these studies show that a particular level is a support, you just refer to the history. Invariably, the players breach the support and go below, hit the stops of all the traders and reverse the market. That we call it as an extended stop, and that they do it during that of the trend reversal time. So don't give importance to that of these levels. Instead, focus on the trading strategies so that you'll be able to earn. It is an earning exercise. You try to do it. And when you focus more and more on the levels, that is going to add more and more of uncertainties to you. And keep in mind that any forecast will have a limitations. And we do not know in this particular trade there will be a limitation or not. And sometimes the going will be good. And especially during the trending time, the going will be good. During the trend reversal time, the market might reverse. So whatever you have followed during the trending time, if you follow the same technique during trend reversal, it does not work. That is why you find that invariably that certain techniques you follow and trade for 2-3 weeks, and then subsequently that same mechanism does not work. Then you go in for an alternative, then that alternative works for a week or two, then subsequently you find the market is not behaving as per the expectation of that new analysis. So it will add only the confusion to that of the traders. The traders jump from one type of analysis to another analysis. And also they follow one analyst and then subsequently another analyst, another analyst, another analyst. By the time the equity would have been eroded, and finally they will become an analyst and start giving all their forecast through that of chat and also free focus through all networking systems, etc. Because they have the urge to trade, but they don't have the money to trade. So what else they can do? They can only just be an advisor to all others. This is what happens most of the time when they are not able to earn. And some people will put all the blame on their luck. Okay, whenever I'm giving or recommending the trades to others, which is working, but whereas when I am trading, it's not working. That is what many of the people have informed me. And I told them that it is not the forecast which is important, because once you trade with your own equity, then probably the market fear is at a higher level, then you do all distress trades. That is why it does not work. So ultimately, one need to understand that forecast has got 50% of the dependence, but ultimately the trading strategy is vital. Then second, both Euro and GBP are below the anticipated level. Do you think that they will further stretch downside? Now, when you look into that, now the gap time is over and the session has started. Okay, we'll watch for 30 minutes during the session. In case if our entries are making profit, we'll try to close it because the forecast is that they will make a small slide. Otherwise, we can wait till tomorrow and book profit following the forecast. So either you should follow the forecast blindly and still use the hedging order to limit the risk, or you can follow the market reading and try to trade. So this is what the system I'm trying to provide. One is the larger forecast, then which is fine-tuned using that of the market reading technique. The gap time, they made the dip and also a small gain, but they are not made any false move closer to low, closer to high. So it is very difficult to identify what they intend to do during the US session. So wait for 30 minutes from the start of the session. So now the time is 14:38. So 14:30 the US session starts, and wait till 15 GMT. Then you will get the clarity whether they wanted to gain or go below that of the initial low, because they come above that of the initial low now during start. As I explained to you, opposite to that of the gap time move. So we can simply close our buy positions now. So AUD, we have the positions here. Euro is 1.1188. Probably we can simply close it. And then GBP is making about 11 pips profit. We can close it. And Australian dollar is making about 10 pips profit. You can close it. So that way, we can simply watch and close, because the forecast says that they will be making only a slide. So my suggestion will be close the position and take 30 minutes to watch what sort of moves they are going to do it in the market, and then subsequently re-enter into the market. Because during the trend reversal time, when the going is good, grab the profit, because they can simply reverse the market in order to induce the traders to do distress trades, because ultimately the players need to earn as much as possible during that of the trend reversal time that they do during that of the early and the late part of the months. And also you would have seen the yearly trend reversal during the month of December and January, how they have done it, and all the S&B corrections, etc. They had done it, and also extended stop and move. They had done it during the year-end time and the year beginning time. So when you anticipate those moves, you can plan your trades accordingly. Otherwise, what happens? People follow the technique and any forecast method and simply use it without understanding there is going to be a seasonal change in the market, and that is called dynamics of market. And so if they fail to understand the seasonal changes, then they continue to follow the same method. And when the season changes and you find such trades are not working, and if they continue to follow it because of ego, then what happens? The usable margin get eroded. And especially during the year end time, you find, or the year beginning time, many of the traders find the margin call comes in. So ultimately, what is more important here is understanding the market, understand how the players make the moves in the market, and then follow a system to understand what sort of moves they are going to do it in the market, and still use the hedging order to limit the risk. Thereby, you will not incur unnecessary loss. Then, Jim, I asked the questions for a swing trade for long-term buy, not intraday short-term. Okay, as far as the long-term trades are concerned, or the position trades are concerned, during that of the trend reversal time, you have to calmly wait, because they are not going to make they are not going to make either upward or a downward extreme moves, and they will make only the trending move from that of the second week. And during that time, we need to understand the type of moves they are doing it. If you listen to the webinars, what I have given it in FX Street in 2011, which is also recorded and displayed under my profile in fxtrade.net, that my trading system webinars, there I explained that the shift in trading zone, they try to shift the trading zone from that of the higher, from that of the lower level. Currently they are doing the lower level consolidation with the downward stop, and then subsequently they will come to that of the middle level and make either way stop ends. Then they will take it to that of the higher level and make higher level consolidation with frequent upward stop end. That is what we have seen it when euro was around 1.38, 1.39 level. They have been doing that higher level consolidation with upward stop end. That's what I was telling you, and they are going to reverse the market. Now they are doing the lower level consolidation with a frequent downward stop end in order to rise it to the middle level. That you need to follow if you are doing the position trades of that nature. And also there are some traders, they do the position trade as a currency conversion trade. Some hold the position for a few days and book profit, but holding the last making position is not position trade. Kindly keep in mind that is the inability of you to understand the market and try to find when exactly you can book profit. If you use the hedging order, then probably you'll be able to do either way trading and earn money. If you simply take position without a stop, and if the position is making loss and the market goes against you, and for several weeks in a month, you can't. We need to understand, pretend. At the time, we should be able to capture the profit. So I take this opportunity to thank FX Street for the facilities provided to give the webinar, and my contact details are given here. And I'll come back on Monday. And give the Asian session live market analysis for the next week. On Thursday, I'll not be able to present the webinar because I'll be out of station. On Monday, I'll come and give the forecast for the next week. Thank you, one and all. Thank you, FX Street, and wish you all happy trading.